Hello and welcome to this session. In the previous session, we covered the types of charts and overlays. In this session, you will learn about the types of indicators, namely price-based indicators, volume-based indicators, and technical triggers. Let us begin with price-based indicators. A price-based indicator is a trend following momentum indicator that shows the relationship between two moving averages of prices. The price-based indicator provides the methodology for forecasting the direction of prices through the study of past market data, primarily price. The market's price reflects all relevant information. The analysis looks at the history of a securities trading pattern rather than external drivers such as economic indicators, news, events, directional price trends, that is up, down, or sideways, that is flat, or some combination. These indicators are generally shown below or above the main price chart. These explain current market environments as a range expansion or a range contraction. It also forecasts when extremes in trends or choppiness are reached so that the trader can expect change. There are three major types of price-based indicators, which are MACD, RSI, Stochastic. We will now learn more about each of these indicators. The MACD is commonly interpreted in combination with the underlying price of a given stock. The MACD indicator turns two trend-following indicators, moving averages, into a momentum oscillator by subtracting the longer moving average from the shorter moving average. MACD offers the best of both worlds, trend following and momentum. The MACD fluctuates above and below the zero line as the moving averages converge, cross, and diverge. MACD turns two moving averages into a single line. Traders can look for signal line crossovers, center line crossovers, and divergences to generate signals. When the signal line goes from positive to negative, a sell signal is generated. MACD is best used in choppy, trendless markets and is subject to whipsaws, that is rapid in and out with little or no profit. The MACD line oscillates above and below the zero line, which is also known as the center line. These crossovers signal that the 12-day EMA has crossed the 26-day period. Positive MACD indicates that the 12-day EMA is above the 26-day EMA. Positive values increase as the shorter EMA diverges further from the longer EMA. Negative MACD values indicate that the 12-day EMA is below the 26-day EMA. Negative values increase as the shorter EMA diverges further below the longer EMA. In the example above, The yellow area shows the MACD line in negative territory as the 12-day EMA trades below the 26-day EMA. The initial cross occurred at the end of September, shown here with a black arrow, and the MACD moved further into negative territory as the 12-day EMA diverged further from the 26-day EMA. The orange area highlights a period of positive MACD values, which is when the 12-day EMA was above the 26-day EMA. The MACD line remained below 1 during this period, which is indicated by red dotted line. This means the distance between 12-day EMA and the 26-day EMA was less than 1 point, which is not a big difference. Moving on to the RSI, the Relative Strength Index. RSI is a momentum oscillator that measures the speed and change of price movements. It is a technical momentum indicator that compares the magnitude of recent gains to recent losses in an attempt to determine overbought and oversold conditions of an asset. It is calculated using the formula RSI is equal to 100 minus 100 divided by 1 plus RS, where RS is equal to the average of X days up closes divided by the average of X days down closes. The most important thing to understand about RSI is a level above 70 indicates a stock that is overbought, while a level below 30 indicates that is oversold. This can range from 0 to 100. A trader using RSI should be aware that large surges and drops in the price of an asset will affect the RSI by creating false buy or sell signals. The RSI is best used as a valuable complement to other stock picking tools. The RSI values become more accurate with longer calculation periods. Here you see an example of RSI. The RSI is presented on a graph above and below the price chart. The indicator has an upper line typically at 70, a lower line at 30, and a dashed midline at 50. The above chart shows McDonald's with a 14-day RSI. This chart features daily bars in grey with a 1-day SMA in pink to highlight the closing prices, because RSI is based on closing prices. Working from left to right, the stock became oversold in late July and found support around 44. The stock did not bottom out as soon as the oversold reading appeared. From the oversold levels, the RSI moved above 70 in mid-September to become overbought. 3 more overbought readings occurred before the stock finally peaked in December. The 4th reading coincided with a significant peak. RSI then moved from overbought to oversold in January. The final bottom did not coincide with the initial oversold reading, as the stock ultimately bottomed a few weeks later at around 46. The final type of price-based indicator we will cover stochastic oscillator. The stochastic oscillator is a technical momentum indicator that compares a security's closing price to its price range over a given time period. It is an indicator that shows the location of close relative to the high-low range over a set number of periods. As a rule, the momentum changes direction before the price. As such, bullish and bearish divergences in a stochastic oscillator can be used to foreshadow reversals. Since the stochastic oscillator is range bound, it is also useful for identifying overbought and oversold levels. Next, we come to volume-based indicators. Volume-based indicators are used to confirm the strength of trends. They indicate the amount of volume for a particular price range, which is based on the closing prices. By combining the volumes and the closing prices, this indicator can be used to identify high volume price ranges to mark support or resistance. Some commonly used volume-based indicators are accumulation, distribution index, on-balance volume, and money flow index. Accumulation or distribution index is a momentum indicator that measures supply and demand by determining whether investors are generally accumulating, that is buying, or distributing, that is selling a certain stock. It does this by identifying divergences between the stock price and the volume flow. As cumulative indicators, the accumulation distribution line is a running total of each period's money flow volume. A multiplier is calculated based on the relationship of the close to the high-low range. The money flow multiplier is multiplied by the period's volume to come up with a money flow volume. A running total of the money flow volume forms the accumulation distribution line. The calculation of accumulation distribution is shown on the screen. Many up days occurring with high volume in a downtrend could signal that the demand for the underlying is starting to increase. It used to identify situations in which the indicator is heading in the opposite direction as the price. Once this divergence has been identified, the trader will wait to confirm the reversal and make his or her transaction decisions using other technical indicators. An uptrend in the accumulation distribution line reinforces an uptrend on the price chart and vice versa. The chart shows Freeport-McMoran, that is FCX, and the accumulation distribution line. Here you see the advancing in February and March, declining from April to June, and then advancing again from July to January. The accumulation distribution line confirmed each of these price trends. Moving on to on-balance volume, or OBV. It is a momentum indicator that uses volume flow to predict changes in stock price. The theory behind OBV is based on the distinction between smart money, namely institutional investors, and less sophisticated retail investors. OBV charts measure the buying and selling pressure as a cumulative indicator that adds volume on up days and subtracts volume on down days. Chartists can look for divergences between OBV and price to predict price movements, or use OBV to confirm price trends. As mutual funds and pension funds begin to buy into an issue that retail investors are selling, volume may increase even and the price remains relatively stable. Eventually, volume drives the price upward. At that point, larger investors begin to sell and smaller investors begin buying. OBV rises when volume on up days outspaces volume on down days. Conversely, OBV falls when volume on down days is stronger. A rising OBV reflects positive volume pressure that can lead to higher prices. A falling OBV reflects negative volume pressure that can foreshadow lower prices. Expect prices to move higher if OBV is rising while prices are either flat or moving down. Similarly, we can expect prices to move lower if OBV is falling while prices are either flat or moving up. A bullish divergence forms when OBV moves higher or forms a higher low even while prices move lower or forge a lower low. A bearish divergence forms when OBV moves lower or forms a lower low even while prices move higher or forge a higher high. The divergence between OBV and price should alert chartists that a price reversal could be in the making. The chart for Starbucks or SBUX shows a bullish divergence forming in July. On the price chart, SBUX moved below its June low with a lower low in nearly early July. OBV, on the other hand, held above its June low to form a bullish divergence. OBV went on to break resistance before SBUX broke resistance. This was the classic case of volume leading price. SBUX broke resistance a week later and continued above 20 for a 30+% gain. Finally, we will look at money flow index. The money flow index, known as MFI, is an oscillator that uses both price and volume to measure buying and selling pressure. The money flow index adds trading volume to the relative strength index or RSI. Hence, it is sometimes referred to as volume weighted RSI. MFI starts with a typical price for each period. Money flow is positive when the typical price rises, that is buying pressure, and it is negative when the typical price declines, that is selling pressure. A ratio of positive and negative money flow is then plugged into an RSI formula to create an oscillator that moves between 0 and 100. As a momentum oscillator tied to volume, the MFI is best suited to identify reversals and price extremes using a variety of signals. Because volume is added to the mix, the money flow index will act a little differently than RSI. First, chartists can look for overbought or oversold levels to warn of unsustainable price extremes. Second, bullish and bearish divergence can be used to anticipate trend reversals. Third, failure swings at 80 or 20 can also be used to identify potential price reversals. Finally, we come to technical triggers such as breakout or break-even. A breakout is a concept whereby prices forcefully penetrate an area of prior support or resistance, usually but not always, accompanied by an increase in volume. A breakout is when prices pass through and stay through an area of support or resistance. Oftentimes, a stock or commodity will bounce between the areas of support and resistance, and when it breaks through either one of these barriers, you can consider the direction that it is heading in a trend. This can be buy or sell signal depending on which barrier it broke through. But breakout is generally a bullish trend. In the given chart, a stock that has historically encountered a lot of resistance near $37 heads sharply higher following the breakout. Coming on to breakdown. Breakdown is a price movement through an identified level of support, which is usually followed by heavy volumes and sharp declines. Technical tools such as moving averages, trend lines, and chart patterns are the most common method for technical traders to identify strong areas of support. Technical traders will short sell the underlying asset when the price of the security breaks below the support level. This is because it is a clear indication that the bears are in control and that additional selling pressure is likely to follow. That's about it for now. Thank you.